Good afternoon to our audience. The whole world just lived through a very difficult 2020, and right now in 2021, I think we have some good reasons to be a little bit more optimistic. And I just want to share with the audience a few points that are in the macro theme. Number one is the vaccine. An effective and widely available vaccine and government stimulus package should be positive to global recovery. On the flip side, a slower than expected vaccination rate and extra rounds of lockdowns may have a negative impact to the market. On balance, there are reasons to believe that a gradual shift to higher growth expectation will occur in the coming months, with more references to a taper in the later part of 2021. Number two, yield curve steepening. As U.S. step up the stimulus package, inflation would likely trend higher starting in the second quarter of 2021 due to a low base in last year. That said, unless oil price surprises on the upside, we expect inflation will likely stay low structurally in the next 1 year. With the Fed's attempt to overshoot a 2% inflation target, the possibility of a near-term rate hike, at least in our view, should be remote. Number three, sanction China SOE. U.S. investors have until November 2021 to divest their bond holdings in China SOEs. Even with the more predictable Biden administration, we don't expect the U.S. will change its stance on China, at least in the short term. Therefore, China SOE names may trade technically weak in the near term as bonds changing hands from U.S. to Chinese buyers. However, given the cheapened valuation and limited impact on the company's fundamentals, we expect China SOE credits would become an attractive play as the changeover settles and U.S.-China relationship becomes more predictable. And lastly, is about the China GDP growth. Following GDP growth of a 2% in 2020 and a 6% in 2019, we see a strong rebound in China's GDP growth at around 8% in 2021. We expect the rebound will be led by recovery in export and domestic consumption. However, we also expect the central government will continue to focus on financial stability. Therefore, credit conditions will likely remain tight in order to reduce systemic leverage. That said, we do not expect the fading credit growth will have a major impact or major threat to the overall recovery theme in China. Now on valuations, Asian credit provide attractive risk rewards for investors to consider in 2021, in our view, especially in the high yield space. As you can see, right now, Asian high yield offers better relative value to our investor. It is trading at around 1 standard deviation cheap for the last 5 years. And arguably speaking, Asian high yield bond with their shorter duration will be much less sensitive to interest rate move. Furthermore, on the absolute yield and spread basis, Asian high yield right now offer in excess of 300 basis points of yield pickup over Asian investment grade bond and over 200 over US high yield. And in terms of the ratio, we are talking about 4-to-1 ratio. And the default rate in Asia is still expected to be quite low in 2021, somewhere around the 2-3% level. So to wrap it up, I think for Asian IG right now, given the massive yield curve rally last year, we think that Asian IG in the current market is fairly valued and therefore offers little room for error. However, on the other hand, for Asian high yield, especially Chinese high yield, it offers tremendous room for spread compression for our investor. Now, let me turn to the China property sector. Because of COVID, property contract sales has been slow in Q1 in 2020. However, we saw a rapid recovery and pickup in strong catch-up in contract sales are beginning in second quarter, and it continued to be quite strong for the rest of 2020. The result is a 12% year-over-year growth in 2020, and the compound annual growth rate, or the so-called CAGR, for the last 2 years was an impressive 13.6% on an annual basis. On the inventory side, the inventory has also come down to a normal level of around 10 to 12 months of supply, thanks to the developers' ability to accelerate contract sales through their various channels and also very innovative customer solutions. On the supply side, on high-yield bond supply, due to the refinancing-only rule by NDRC, we expect net supply to be low in 2021. We expect high-yield gross issuance to be around $45 billion in 2021 versus $41 billion of maturing bonds. That means the net issuance will likely to be around $4 billion for the year, which is one of the lowest in recent histories. The low supply will be technically positive to China high-yield bond. So in 2021, the takeaway for the China property sector is the physical market will likely to remain quite stable. However, investors should expect there will be some divergence in the city cluster performance in terms of contract sales. Obviously, the tightening measure will be here to stay, namely the 3 red line policy is there to control leverage, and also the continuous emphasis of the theme of how is the living and not speculating in China. So therefore, we expect the property sector will enter an area of controlled growth in which we may see margin pressure among companies. However, we believe that companies' strengthened cost control as well as their delicate sales management will partly mitigate that risk. So on China property, we prefer solid single B credit with strong fundamental and reasonable spread pickup versus benchmark double B names. And we also, on the high beta area, we prefer the single B high beta with improving credit matrix and also re-rating potentials. So lastly, 2021 could be the year of normalization where we can expect to see some sort of normalization to the various aspects of our life. However, the path to return to normal could be uneven, and therefore investors should still be mindful of sporadic volatility in the market. To sum up, therefore, we expect an investment strategy that focuses on strong income generation and managed volatility is worth considering. Thank you very much.